Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenevec on Bloomberg Radio.
Well, we start today with the news out of Vatican City. Cardinal Robert Francis Prevost was elected to the head of the Catholic Church. It was the second day of voting in the Vatican. It is the first U.S. national ever to take the role. He's 69 years old. He was born in Chicago. He spent much of his life outside the U.S., mostly in Peru and Rome. Leo XIV is the name that he has taken. He spoke for about 10 minutes last hour in Italian, Spanish, and Latin as well. For more, we bring in Natalia Imperatori-Lee, professor and chair of religious studies at Manhattan College. Professor, good to have you with us this afternoon. We are sort of slowly learning details of the new pope. The big question I have is, what direction do you think he will take the church in?
Thanks for having me. I think this is a really interesting choice. We can tell a lot from him by the choice of name. In choosing Leo XIV, I think he's indicating that he wants to continue the work of one of the most consequential popes on the topic of social justice. So Leo XIII wrote a huge encyclical called Rerum Novarum, and it basically set the agenda for the social work of the church. And so I think this American pope is signaling to us that he will be on this sort of maybe a little bit kind of in the progressive vein that you saw Francis in.
Yeah, it does look like that is an encyclical that was aimed at the working class. And of course, Pope Francis was first and foremost concerned with helping the poor. What about immigration? Right. This is obviously the divisive issue on which the Catholic Church under Francis and the United States government under President Trump have had the most disagreement.
Yeah, I think it's going to be really interesting because this is not a typical kind of U.S.-based bishop that we're getting as the Pope right now. This is a man who's lived all over Latin America. He's done a lot of diplomacy. He's done a lot of church building and bridge building in other places. You heard a lot of that actually in his opening speech about building bridges and walking together. And I think that he, with his experience, especially in poor areas in Peru, he understands what's going on with migrants and the sort of needs of people who are in desperate situations. And so I don't anticipate that he and the current president of this country will be on the same page necessarily when it comes to migration.
What is the significance of a pope born in the United States, the first American-born pope, the first U.S.-born pope? Especially following the first South American pope.
It is wild. None of us thought that this was going to happen. No one that I know in the Catholic universe thought that we would get an American. And so it's pretty crazy to have two Americans, broadly understood, back to back. I think it signals a kind of move away from a European-centered church to a more global reality. And so you have this guy who, yes, is from a global superpower, the United States, and Chicago, a superpower city, but nevertheless is someone who was very immersed in Latin American culture and then in the culture of the Vatican. So you can see this sort of global preference that the cardinals are starting to show, that they want to show that they have an openness to not just a European church, but really a more global reality.
What's the likelihood that he can heal the rift between the Vatican and American Catholics? Because it definitely had developed, and you mentioned this isn't the typical American cardinal, those who had spoken out openly against Pope Francis. Can he bring the kind of Al Smith Catholics back to the church?
I mean, it's my sincere hope that that is the case. The question is, can the Al Smith Catholics get on board with the papacy? I mean, the whole point of a lot of this sort of disagreement is who is really in charge, who should really set the agenda, for the Roman Catholic Church. And it's important for us. I mean, as Americans, I know we feel a lot of like patriotism and everything right now, especially because he's an American Pope, but he's going to be the Pope of the whole global church. And so sometimes we can be a little bit short-sighted and think, oh, well, he's not responding to the things that we care about the most, but he is trying to steer this ship that's kind of enormous.
Well, 1.4 billion people. We should remind everyone, 1.4 billion people, right? The longest standing institution in the Western world. And do Catholics believe that the Pope, the leader of the church, is chosen by divine intervention, that essentially God has picked this Pope?
I mean, yes, but let me give you a caveat, right? God works through human beings. It's not that God whispered the name Prevost in the ear of every cardinal elector, and that's how it happened, right? It's not Harry Potter. It's very much real life. And so we believe that God doesn't let the church fall completely into error, that we believe or we trust that God is somehow in control of this church. And that is very much what sort of is we see happening in a conclave. Nobody knows what goes on inside. You sort of really have to trust. And even the men who are in there are, in a sense, putting their trust in, we don't really know how this is going to turn out. We're going to sort of lay it at the feet of God. And that's how Catholics think God works in the world.
I was pretty shocked to emerge from a meeting just after noon here in New York and see white smoke up on the Bloomberg television screen, given that the conclave just started yesterday in Vatican City. And, but looking into this a little more, that's not necessarily that unusual, at least in modern times. They're not necessarily going to be holed up for weeks. Historical context for just the duration of this conclave, is it surprising to you, or is it pretty quick?
I mean, it felt quick, I feel like, because like you, I feel like they just started yesterday and what's the deal? But it's usually 4 to 5 ballots, right? That's pretty much what it's taken the last 3 times, 4 or 5 ballots. They're very efficient with their voting. I definitely didn't think it was going to be Prevost this quickly. So I was in a meeting with a student and I had to sort of freak out and cancel it and move away from it. But yeah, the white smoke came quickly, and it was a surprise that it was Prevost. Now, I will say this. He is the guy who was advising Pope Francis on who to appoint as bishops. And it's really significant that he is now the new pope. It tells us that Francis's vision for who should be in leadership in the church, which is like people who were pastors, that's what Francis really wanted, that this Leo XIV is going to continue that sort of vision.
He actually started off quoting Pope Francis's Easter Sunday words. Do you expect him to carry on Francis's work, not only in terms of helping poverty, working class, but also in terms of women in the church, in leadership, in terms of LGBTQ, bringing a sense of inclusiveness to this Catholic Church that traditionally, at least in leadership, only relies on men?
I mean, I hope so. I don't know. I don't know where he stands on the issue of women. I can only rely on what he said from the balcony. And a lot of that was echoing so much of what Francis was saying. So you heard him hit all the greatest hits, right? He talked about peace 100 times. He talked about building bridges 100 times. He talked about walking together to the promised land. He kept saying tutti, tutti, which was it means everyone, which was a refrain of Francis's. He talked about a church that was open to all, that needed to dialogue, that needed to do encounter. And that, I think, signals that he wants to continue the legacy of Francis. Now, as for the specifics, right, will he continue to appoint women to decision-making positions in the Vatican? I hope so. That's not some toothpaste, I think, that'll go back into the tube very easily. But we won't know, right? This is, again, where Catholics are like, come, Holy Spirit, let's do this.
Professor, really appreciate you joining us on Bloomberg Businessweek Daily this afternoon. Professor Natalia Imperatori, professor and chair of religious studies at Manhattan College.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, a hard pivot from Vatican City and from what's going on with the Pope to the other big story of today. And that, of course, has to do with trade. President Trump announced a trade framework with the UK. hailing it as a, quote, breakthrough that will bring down barriers and expand market access for American imports. The president said final details of the pact would still be negotiated in the coming weeks, but under the agreement, the UK would fast-track American goods through their customs process and reduce barriers on ag, chemical, energy, and industrial exports. Here's what he said a little earlier today.
Both countries have agreed that the economic security is national security and will be working together as allies to ensure that we have a strong industrial base, appropriate export controls, and protections for key technologies and industries like steel. Steel is a big factor. Both countries will become stronger with steel.
That was President Trump earlier in the day from the Oval Office. For more, we bring in Bloomberg News UK government reporter Joe Mays and Bloomberg Economics U.S. economist Stuart Paul. Joe's in London. Stuart is here in the studio. Joe, I do want to start with you and just contextualize the framework, or at least the details with what we know in the framework between what was there before Liberation Day, so-called Liberation Day, and what is the status now after this framework was announced? What are the big differences there?
Yeah, so the context is that the US brought in these quite punitive tariffs, particularly on the car sector, steels, aluminium, in excess of 25% for those industries. And that was very damaging to the UK economy. And after the deal today, there is relief for those industries. So on cars, the tariff going down from 27.5% to 10% for a quota of 100,000 vehicles, which the Prime Minister Keir Starmer was hailing as a victory for companies like Jaguar Land Rover. The steel tariff has gone from 25% to 0, similarly for aluminium. So those are the real big tariff wins that the UK wants to talk about. But nevertheless, there are still these 10% baseline tariffs on the rest of goods that the UK trades with the US. So it's still a weaker position for the UK than before Donald Trump became president, but it's better than things were yesterday. That's how Keir Starmer was framing it. So it's a limited political win for the UK, whilst still suffering effectively from the remaining tariffs.
What about U.S. access to the UK market? And one of the things Donald Trump has talked about for a long time is that, Europeans, and I suppose he includes the Brits in that, don't buy American products. And of course, he's talking about cars. Is the UK market going to be far more open to U.S. goods than it was before this agreement?
Well, yes, there was included in this agreement provisions to liberalize access to UK market for food products, for example. For example, beef exports can now come into the UK from the US in a way they couldn't before. So that was hailed as a victory by President Trump. Tariffs on ethanol exports into the UK, they're also now being removed. So yes, there was a liberalization here. It wasn't an enormous liberalization that, for example, on food standards, the UK is still saying that it won't, for example, accept hormone-treated beef into Britain. So that's a kind of a limitation on that liberalisation, but still
extreme limitation.
It's more access than previously.
Hey,
yes.
Stuart, I want to bring Stuart Paul in of Bloomberg Economics. He joins us here in the Bloomberg Businessweek studio. Equity markets certainly cheering this, and we should note the fact that the president did make comments about buying U.S. equities earlier in the day as well when he was in the Oval Office earlier. Stuart, what is the view from your perch at Bloomberg Economics of what this means for the U.S. and sort of how it could illuminate maybe a framework moving forward for deals?
Just, we know that we're on a de-escalatory path. This concretizes some of it. It gives some sort of shape to what we could expect from deals going forward. It might be a piecemeal approach, and this can be something that takes a long time to develop. As we heard from Secretary Bessent, there are 17 key trading partners that the U.S. is approaching deals with. If they all take this shape, they're all going to have a relatively dull sort of impact on U.S. economic activity. What'll really shift most is sentiment around U.S. engagement in the world. So just recognizing that we're on this sort of de-escalatory trend and that there's not going to be just a full retreat from the global stage.
What would be the best for U.S. economic activity? I mean, it doesn't seem like the president's going to lower at least the baseline tariffs below 10% for any country if he won't do it for the UK.
Yeah, so even if he doesn't lower the baseline tariff, creating enough carve-outs does open up, so it does sort of generate additional economic activity, and it brings the average effective tariff rate significantly below what that 10% baseline is. So if we think about what the average effective tariff rate was on the UK, it was just a touch above 10%. Now with these carve-outs, the average effective tariff rate in the UK drops down to about 7%. So what does that mean, let's say, for the UK in terms of economic activity and growth, where there was about 30 basis points of drag on real GDP growth for the UK? Now it'll just be about 20 basis points of drag. So that'll keep GDP growth just a touch under 1% for the full year. That's according to our UK forecast.
Hey, Joe, on that point, based on your reporting and what you've learned about this deal, does it seem like it's a better deal for the US, it's a better deal for the UK, or are they kind of equals when it comes to the table here? Is it win-win?
Yeah, I mean, it feels like a better deal for the US if your reference point is the day Donald Trump becomes president, because compared to that day, the US has gained a fair amount here, kind of agricultural access for many products, the ethanol thing I mentioned, and still has these 10% tariffs on the UK. And the UK is in damage limitation mode with this deal. So better than yesterday, but clearly not as good as it was when Donald Trump first became president. So yeah, I think the US is, I think, coming out of this slightly stronger, although the UK obviously is trying to claim that the wins are on their side.
As we mentioned, Joe, this is a framework right now. Some of the details continue and need to be hashed out in the coming weeks. What questions do you have? Like, what's the fine print here that we don't really know yet?
So the UK said that this, for them, is really a starting point, if anything. There's still much more to happen when it comes to negotiations. There are things like the digital services tax, which the US wants to see reduced. It's disliked by the likes of Facebook, Google. Indeed, Elon Musk really dislikes that tax. That could form part of a digital agreement that's still to be negotiated, the UK has said. There's also other tariff lines which the UK would like to see removed, but that's subject to further negotiation. The pharmaceutical sector, for example, very important to the UK. There wasn't explicit reference to that in the agreement today, so we'll have to see what happens there on tariffs. So there's still much more to come here. President Trump was trying to say this is full comprehensive, we've maxed it out, and the UK was saying, well, actually, there's still a lot we still want to talk about here, but we'll play nicely for today.
Joe, I wonder about the importance of automotive to the UK economy. It's become clear, I think, to a lot of people over the past few weeks, certainly since April 2nd, that global trade is car trade, really. How big is it in the UK, especially when you're just looking at exports to the US, right? Because I only can think of very high-end, Gordon Murray automobiles, McMurtry, McLaren, Range Rover, Rolls-Royce, Bentley. It's not the mass production vehicles, as Tim was mentioning, like Toyota and Nissan. Even though you make them there, you don't make them there for our market.
Yeah, that's right. It's premium cars that the UK tends to sell into the US, and exports of UK cars to the US were about 100,000 at the last count, which is basically covered by this quota that's been announced today, 100,000 quota at 10%. So you can see why the UK is happy with that arrangement. I think the UK car industry has been, broadly speaking, in decline in recent decades, but nevertheless, it has carved out this niche in high-end luxury vehicles, and the US was an important market. So there's a kind of symbolic win here for the UK. It won't have massive impacts on the UK economy writ large, because it's still a fairly small part of the UK economy, but nevertheless, it's a kind of nice symbolic political win for Keir Starmer to say, look, I have managed to reduce these tariffs, and he was saying today this preserves jobs across the UK, so that's something to be celebrated.
We're having this conversation, Stuart, in the context of a United States that has essentially said, now is the time to come and negotiate. We know that the Treasury Secretary is headed to Switzerland this weekend to meet with representatives from the Chinese government. We're not talking about China here, though. Does any of this matter without a deal with China?
China, of course, matters most. Accounts for about, 15% of our total imports. We're running a trade surplus with the UK. It really doesn't matter a ton to the US if the average effective tariff rate on UK goods is somewhat higher. Once you start creating carve-outs for things like pharmaceuticals and everything else under the sun, we're going to drop from probably a current effective tariff rate of 7% on UK imports to something closer to 3%, not really material. What I do think is the most material is this idea that when Trump took office, the outward expression was one of an interest in withdrawing from the global stage. Now, directionally, we're moving in the opposite direction. We've had public statements from folks like Besant and everybody else saying that 145% effective rate on China is not something that's sustainable or that can remain in perpetuity. And so, again, the direction is towards de-escalation. And I think that that's what matters most. This is not going to be just the complete crack up of the global commercial order that was threatened. There will be a turning of the tide and a bit of a shifting. But we knew that was going to be the case with friendshoring and onshoring, as opposed to, retaliatory or reciprocal tariffs being the terminology of the day. We knew this was going to be the direction under Trump.
By the way, I forgot to tell everyone Happy VE Day because it is May 8th, right? It's Victory in Europe Day. Joe, Happy VE Day.
Thank you.
What do we know about the European Union? I mean, the US-UK agreement has been the main headline, but we've got another flurry of trade headlines with Gulf sovereign wealth funds, with critical minerals deal in Ukraine, and the EU talking about tariffs on $95 billion of U.S. exports. What do we know about the EU deal?
And what we know is that clearly it's a big priority for both sides to get some kind of agreement done. And we're all kind of reading the tea leaves today on the UK agreement to say, okay, clearly the US is willing to do this on trade, so might they be willing to offer the same on the EU? But clearly it's different when it comes to the scope of those kinds of deals. Obviously, much larger economies, much more trade at stake. It's really a kind of a watching brief at this point, trying to see, will there be movement in these coming weeks? Clearly, as we've just been discussing, the direction of travel from the US side is towards wanting that engagement. But the EU, we know, strikes very hard bargains in these negotiations and is unlikely to kind of concede too much in those kinds of talks. So, yeah, it's still a watching brief.
Joe, a lot of questions about the status of American beef going to the UK. What can you tell us just about American agriculture and access to the UK market and how that could potentially change under this framework?
Yeah, so this has been one of the biggest sticking points in the UK-US trade talks historically. It's one of the reasons why it's been difficult to get a kind of big, comprehensive free trade agreement in recent years. And what's happened here is that the UK has said, yes, we will allow for the import of US beef, but on the condition that it reaches UK food standards. Now, those food standards are standards that the US has long criticized as being ascientific and unnecessary, but in the UK, they are seen as exceptionally politically important. And we're talking here about things like hormone-treated beef. Mm-hmm. And indeed, for the UK, it's very important to maintain those standards if they want to do a deal with the EU, because the EU is particularly hot on having those standards upheld. So what the UK has done here is can walk that tightrope and kept open the option for deals with the EU by keeping that restriction in place, but nevertheless giving the US a win by saying you can import some beef into the UK now, much lower tariffs and so on under a quota, but just not hormone-treated beef. So you can see why it's a kind of a halfway house.
I want to give Stuart the last word. One of the reasons we love getting you on, Stuart, is because you're able to make these quick calculations about economic impact of certain events. And I'm going to put you on the spot here and just give us your view on the Pope. Sure. And what it means for the U.S. economy that he is actually the first U.S.-born Pope to lead the Catholic Church. Do we have numbers here?
Sure. So what really matters is if he's going to come and visit the United States, right? Famously, Pope Francis wouldn't really return to Argentina. But if we were to see now Pope Leo XIV coming to the United States, it could mean a material increase in spending. If we're just extrapolating based on the economic activity boost from, let's say, Francis's visit to Philadelphia or Seoul in 2014 and 15, and just adjusting for inflation and accounting for what the impact would be if the Pope visited, say, Chicago, his hometown, you could expect about $1 billion in additional economic activity. That's about 5 basis points of additional spending growth in any given month. A 4-city tour or 5-city tour, like that is a pretty big papal pop in economic activity from a tour coming from the Pope.
Okay, so maybe not Taylor Swift, maybe not Beyonce, but the Pope certainly could have a huge economic impact.
If he does a whole tour, it would be a different story, right? He wouldn't likely just go to Chicago. He would bring over his whole entourage, probably at least one Pope mobile. So I imagine he would go, New York, D.C., Chicago. Maybe.
Yeah, I mean, the travel expenses, the security expenses for each city visit, that's probably close to about $50 million. But yeah, this is not quite Taylor Swift, but they're still talking about filling Wrigley Field, right? That huge. Is a good amount of economic activity that's generated.
All right. Well, a big thank you to both of you. We covered a lot here. We went around the world. Joe Mays, our Bloomberg News UK Government reporter, joining us from London. Bloomberg Economics, U.S. economist Stuart Paul here.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I'm Carol Massard. We're at the Principal Asset Real Estate Conference here in Pleasant Valley, Arizona. We're going to continue our coverage here. I want to throw out one little stat as we continue. Nearly half of family offices say they plan to increase allocations to real estate in the coming months with an emphasis on residential and industrial sectors. This is according to some research out from Knight Frank. So let's get to it. I'm curious what Rich Hill has to say about it. He's Senior Managing Director, Global Head of Real Estate Research and Strategy at Principal Asset Management here at the conference in Arizona. Rich, good to have you here with us. How are you?
I'm great. Thanks for having me on today.
Well, it's great to have you here. I love folks who have seen some different cycles. How do you make sense of this cycle right now?
Look, every cycle's different. I like to begin by saying commercial real estate valuations are down more than 20% from their peak in 2022. That's a generational decline in private real estate valuations. We've only seen that 2 times before, in the aftermath of the Great Financial Crisis and in the early 1990s post the S&L crisis. So heading into this year, commercial real estate valuations felt like they were on pretty good footing. Then April came and tariffs threw a little wrench in that equation, leading to some questions amongst investors.
Well, it's interesting, too, when I think about mispriced assets. So how mispriced are they then today in terms of too low in terms of valuation? Which are some assets that maybe still need a little bit of work here?
Yeah, great. That is a really interesting question because as you think about what's mispriced, you can think about that on an absolute basis or a relative basis.
Great point.
Where we think about assets that are mispriced, it's assets that are actually going to grow very strongly over the next 3, 5, or 10 years. Those are, in many cases, alternative sectors that many people don't think could be considered traditional commercial real estate asset classes.
Right.
Things like data centers,
right,
or cell towers, or seniors housing, or single-family rentals. These were asset classes that didn't exist in the commercial real estate sector 20 years ago, but are now a big portion of the commercial real estate market.
Yeah, I love that you go there. There's also variations, I'm assuming, in terms of geography, right? When you look at what's mispriced, what's not.
For sure. As we think about what has done really well over the past 5 years, it's been driven by population migrations.
Right.
So many of the Sunbelt markets boomed in valuations. And you're beginning to see some actual growing pains in the Sunbelt market.
One of the things I love that you said, longevity. Deborah Cafaro of Ventus was on this panel I did at Milken, and just, she's been, obviously when it comes to senior living centers, obviously the healthcare side of it, but that longevity play, especially when it comes to real estate, that's one that's going to stick with us for a while.
It is. What I don't think a lot of people may understand is that the aging demographic has lived in their houses for longer periods of time. That's actually created some structural imbalances in the single-family home market. But we think this aging demographic will ultimately move into seniors housing, whether it be limited service senior housing,
right,
all sorts of different seniors housing. And this is going to be a long-term structural shift that's here to stay.
That is a global trend, right?
It is.
It's not specific in terms of different markets. One of the things I wanted to say, looking at how U.S. REITs are performing, as a group, they're up about 1% year to date. They've bounced back along with the rest of the U.S. market. They're nearly up 12% since early April. You look at European REITs, they've bounced nearly 17% since then. What does the trend tell you about investor sentiment and the willingness to maybe go back into the market? Is it just the overall, bounce back, or is it something more substantial?
We think it's something much more substantial. REITs, while they've had good years in the past couple years on an absolute basis, they haven't been a favored sector in the S&P 500 or the global stock market. But we think the listed public markets are a leading indicator in both downturns and recoveries. So the public markets are sending a signal that commercial real estate might be a relative winner in this new backdrop of higher interest rates and higher inflation. It's a really fascinating topic that I don't think is getting enough attention. Listed REITs in the United States, real estate in the United States, is the fourth best sector of the S&P 500, despite all the headlines you see about what's happening with tariffs, what's happening with growth, what's happening with interest rates. The public markets are telling you that you should be focusing on the commercial real estate
How do
market.
you make sense of that in terms of a higher for maybe longer rate environment, certainly in the United States? And it's not fair to say, the ECB, we saw, certainly has been cutting rates. We saw the Bank of England cut it. So it's not all, the same rate strategy when it comes to global central banks. How do you make sense of that, though, in the United States?
I'm often asked, what do I think about this new normal environment of higher inflation and higher interest rates? rates.
Right.
I reject the premise of the question. What was abnormal was the last 10 years of low interest rates and low inflation. Commercial real estate actually doesn't do that well in that environment, at least on a relative basis. Where commercial real estate actually does well is what happened prior to the GFC.
Right.
A higher interest rate, higher inflation regime has existed for decades. And that's actually fairly accommodative for commercial real estate because guess what? It's a growth sector.
What about office? I just want to go there. I feel like we've been talking about it since the pandemic. Here we are, 5 years out? And I don't know whether the big shoe has yet to drop. Expectations in terms of that within the real estate sector.
If you're going to ask me, is office going to be an attractive sector over the next 10 years or beyond?
Yeah.
I have to tell you, yes, it's going to be.
Why?
There's a couple different reasons. First of all, last cycle's winners are rarely next cycle's winners. Office properties have been beaten down so much, and they're redlined by much of the investor base right now, that they're beginning to screen at an attractive valuation, especially for the high-quality, well-positioned properties. I would consider myself office curious right now. I think it is an attractive asset class over the medium to long term. The signal that you should be looking for is an opening up of lending to the office sector, and I think we're on the cusp of seeing that in 2025.
Coming from the private markets more so than the big banks?
That is correct. People like Principal Asset Management, one of the themes that we heard on our panel earlier today is, is there an opportunity to begin lending on high-quality office at a reset lower basis? I think that might make a lot of sense.
I am curious, as you guys have conversations here at the conference, you've got some really big clients, big investors here. What is top of mind for them when it comes to real estate? And I hate to keep putting it all into one bucket because it's, as we know, there's different verticals, there's different geographies, and I think it's an important distinction. But I am curious what they're asking you.
Yeah. What's happened over the past 20, 30 years is that commercial real estate has benefited from a secular decline in 10-year treasury rates.
Right.
Borrowers have been, or investors have been able to refinance and lower interest rates, which has helped valuations. I think a really big theme coming out of this conference is back to basics. What property type and what market will drive long-term growth? That's really refreshing to me because financial engineering has driven returns for the past decade or so, decade plus. We're now getting back to, all right, fine, what property type do I think I'm going to get 3% net operating income growth, revenue minus expenses?
Right.
Where can I actually generate the high, attractive, unlevered IRRs? You actually don't need that much growth relative to history to get there. So I think there's a lot of investors acutely focused on what property types and what markets to buy.
Rich, it's more like being back to normal, right? I mean, I know everybody kind of forgets that what we saw for such a long time where there was basically no cost to money, right? That was the unusual point.
You call it back to the future, call it back to normal, whatever you want to. This is a really refreshing environment where you can actually block and tackle, if you will.
I want to ask you, variations, U.S., Europe, Asia, Middle East, the supply chain as it moves around, geographies that maybe didn't get a lot of attention that are now getting attention. Like I keep bringing up this idea that Disney's not going to build a theme park in the Middle East. I talked to a lot of folks at Milken who were like, we opened up an office somewhere in the Middle East. So I am curious, when you look around the world, where is it all of a sudden getting a lot of investor attention when it comes to the real estate play?
We think one of the most significant trends of the next 5 to 10 years might be the European continent, and specifically
definitely Europe,
and specifically building logistics on the European continent. Why is that the case? Well, the European countries might have to trade more with each other, and most warehouse facilities on the European continent are actually relatively old. Call it 10, 15, 20 years old.
Right.
That does not accommodate new modern trade. So to be able to build new logistics facilities on the continent could be a really interesting theme that's coming out of the next evolution of where we go post-tariff.
Does that also include ports? Like ports all of a sudden? One of the things that came out of the discussions at Milken too was like that West Coast port. One of, that maybe it'll be busy, but maybe not as busy as it used to be. So I'm just curious when you think about that as well, the infrastructure build for that.
Absolutely. You have to find these right ports on the European continent, and maybe even the UK, that will change the shipment of goods. Maybe in the U.S., one of the ports that I think is most interesting is Savannah, just to sort of levy off of what you were talking about.
Got a lot of family down in South Carolina, not Savannah, but nonetheless, there's so much activity. Just to wrap up here, where do you think is the biggest opportunity when you look out? Again, real estate's a longer-term play, so I think it's either 3, 5, 10 years. Where do you think will really present some really unique opportunities for investors.
Yeah, so I'll just conclude commercial real estate is actually 18 different sectors that fall under a broad umbrella. There are always opportunities someplace in the world for some property type.
Right.
I do think European logistics is a really big opportunity. We think seniors housing is a really big opportunity.
Globally, right?
Globally. One of the themes that I've been really surprised about to hear, because it's a relatively niche sector, but it levers off of seniors housing, is medical office buildings. I've been hearing a lot of investors talk about medical office buildings. So there's going to be some really interesting opportunities that come out from the shakeup. And I'll come back to the question you asked about office. I'd be remiss if I said over the next 10 or 20 years, it sort of feels like it's ready for a rebound at some point.
People are actually going back to the office, aren't they?
My train into New York City is at 97% of capacity.
It's happening. It's happening. Really great stuff. Thank you so much.
It was great meeting you.
Yeah, same here. Rich Hill, Senior Managing Director, Global Head of Real Estate Research and Strategy at Principal Asset Management here at the Principal Real Estate Conference.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Jim's back in New York. I'm here in Arizona, and I'm here at the Principal Real Estate Conference that's been underway. I want to jump right in and get to our next guest. He's Kamal Bhatti. He's President and CEO of Principal Asset Management. Kamal, it's been really fun talking with your team because I think amid uncertainty, volatility, when you think about some of these asset classes like real estate, investors are in it for the long term. So there is a sense of calm and understanding that we're going to go through cycles. Talk to us a little bit about your check-ins with your team on a regular basis amid kind of the backdrop that we've had.
Absolutely. First of all, Carol, thank you for being here.
Thank you.
In Arizona, it's an honor. Real estate is the heart of our business. We're one of the biggest managers in the world, and it's great to have Bloomberg join us here at our premier conference. So thank you for that.
You guys have been doing it for a quarter of a century.
We have been. We have some experience through market cycles, which probably matters more than ever before.
Yeah.
So to your question, I think sort of uncertainty seems to be the most commonly used word these days, and I would say probably the word I want to focus on is clarity, because as investors, I think that probably is the more important word to focus on, what you can get clarity on and what you can get clarity on.
Right.
In fact, one of the things when you really think about long-term trends, because there's a lot of short-term noise, the two things I think we can have absolute clarity on is the world is aging, and there is money in motion in retirement. And I think if you really think about the needs of those investors in retirement, which we are a premier manager, almost $320 billion of our assets sit in retirement, the needs for those investors are like only getting more important. And if you really bring that back to an investing landscape, with what we have now is in the trade wars, deglobalization, the one thing that is clear to us is you have to have local knowledge and footprint as you navigate this environment. You can't run portfolios just with a U.S. mindset. You got to have intelligence on the ground.
Right.
If you're trying to do something in Asia, you're trying to do something in Europe. And that's been the key thing that I would tell investors need to focus more and more on. Local knowledge and clarity on what's happening in the local geographies is going to be way more important than it's been in the past.
I think that is so smart, because I do think, we throw out global real estate. I've said this a couple of times in the conversations today as a bucket, but there's just so many different dicing and slicing of it, if you will, in terms of the different types that are out there. One of the things I am also curious, you guys have been doing this for a long time, and it just felt so uncomfortable, but you think of something like the Great Financial Crisis.
Yes.
This is nothing like what we saw during the GFC, right? No. When it comes to real estate and just in general market volatility.
Correct. And look, I think we've had such ultimate calm on what I would call political policy. We over post-GFC, so much of our attention went to fiscal and monetary policy. I would say monetary policy more than anything else.
Right.
And fiscal policy comes into vogue on and off, but it was really monetary policy was the driver of what all investors thought about. And now I think we are entering an era where I would say political policy and fiscal policy are going to be the driving forces of markets moving forward. And it's sort of, you have to recalibrate your mind.
Is that a better thing in your view?
I think it's a different thing.
Okay.
I wouldn't call it a better thing.
Okay.
I think we have gotten used to, I go back to this word around clarity, central bankers became very, very good at providing clarity.
Yeah.
if you look at the history of how investors have reacted, such attention gets paid to interest rates, what central bankers say, and that sort of became the words they chose and how they said it, allowed investors to build a framework and invest around it. While we can rely on that,
right,
it is you can get the same level of clarity from the political policy today, not just in the US, but across the world. And the fiscal policy is much more in control of government organizations. And so you have to do a lot of individual work
right,
and incremental work as an investor if you want to seek clarity. And I think it's going to be good for markets. Why it is going to be good for markets, in my mind, is we've had sort of a collective viewpoint
right,
of where markets are going. And I think there's a bigger dispersion in investors who think where the world is going.
It's interesting that dispersion, I feel like that is a word I'm hearing more and more often in terms of just the variations. And you've really got to kind of do your homework. I want to go back to what you talked a little bit about, aging, longevity, retirement, the democratization of especially the private markets. Is that going to increasingly, whether it's exposure to real estate or other, important for ultimately folks really hitting their targets when it comes to retirement? And what do you want to see in terms of policies?
Absolutely. Great question. So I was just earlier this week at Milken, and that was a big topic. You know, private markets. Before that, I'm on the ICI board, Carol, and that's become a topic there. So this notion of retirement and private markets overall is a big topic. But I would say the three big trends in the retirement space are, in addition to private markets, there is innovation. And innovation is not just investment innovation. There is technological innovation that will play a role for these products to deliver their outcome. And then the last piece is I go back to policy. These markets are highly dependent on where regulatory policy evolves. And I would say the retirement investor is absolutely not participating in private markets today. They're almost like sitting on the sidelines stuck because there's no clarity on the regulatory policy front of how they should access this. And while there is innovation of how to do it, it is not there yet. Going back to real estate, I would say it is probably the first door you have to enter if you want to allow private markets.
Interesting.
And as an investor, it should be really easy to understand.
Why?
And exactly. I would say of all the asset classes, real estate is probably the most different from bonds and stocks. You know, people talk about private equity, people talk about private credit. They are different, but they're not that different. Real estate at the core is different. And so why are we going to do this? It's all about outcomes. So you want to add things that diversify you further.
Right.
So real estate, makes the first logical argument, and academic literature even says that. It's you got to pick the most diversifying asset first. So that one makes sense. Two, it is deeply global, and it is wide and deep. Real estate exists all across the world. You know, we have REIT markets. And so the second thing you want to have is, if you want to do it in retirement portfolios, you want to have public and private proxies for doing something. Real estate is one of those asset classes. You could buy direct, or you could do REITs. You could buy bonds, or you could do equity. It is a complete 360 asset class. And at the end of the day, the saver, which is really mom and pops who are saving for retirement, want to have an asset class that's deep, and you can implement your views across the world in a good way. That's probably the best reason I would argue.
You know, it's funny, at Milken, and one of the guests, I said, you know, is there going to be a period where, like, we don't really care about the public markets anymore? And like, they looked at me like I was black, you know, what are you saying? But it just increasingly, the shift, private markets has certainly been a topic, as you know, at Milken for a long time, whether it's real estate, like pick your thing. And I just wonder, you know, how are the majority of investors, 401ks, like your mom and pop, what they are missing out on? So
I would say what they're really missing on is having access to all asset classes. And as you said, they're largely in publics, but public will have to be the core of the portfolio. You know, you need to manage liquidity in these portfolios, and it is by far the biggest component of market access today is in public markets.
Just got about 30 seconds left here. Real quickly, Secretary Bessent kicked off Milken talking about American exceptionalism, basically best place for the U.S. How do you see it? Because you look at real estate from a global perspective.
So here's what I would say. I think...
Just quickly.
Just quickly. America will remain exceptional in technology, not sure about every sector of the economy.
All right. You are quick. You know how to take cues. Really, really appreciate it. And it feels like a lot more optimism. Than some of the uncertainty and concerns. Kamal, perfect way for us to wrap up our coverage.
Thank you, Karen.
Thank you so much for inviting us. Really enjoyed the conversations.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.